Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry market analysis and trade ideas webinar. It is currently roughly 5:20 p.m. Eastern, end of the North American trading session, Monday, July 24th. Now, I want to talk about something before we jump into the intraday trade ideas and analysis, and it's just about understanding higher time frame price points that have fundamental significance to them. And a great example is what we're going to be talking about here on gold. This is also going to tie into potential expectations of FOMC this week, and I'll also be breaking that down in more detail shortly. But first, let's just break down something very simple in understanding gold, how it behaves, and how it moves, but also understanding fundamentally significant higher time frame price points. So what do I mean by that? What I mean by that is we, of course, in Capital Hungry understand that there are important real world events that come into play that have a significant impact on how order flow from an institutional perspective enters the market, right? A very simple way to break it down is understanding the changes in risk flows. With the example of gold, something that's primarily seen as a safe haven asset class and an asset class to move or pool liquidity into when you're looking to hedge against increasing market or economic risks. This is something very easy to understand because whenever you have any fear, uncertainty, or doubt, you clearly see more of an inflow, more demand in gold, and gold more technically bullish, as we observe when we look at our charts from a retail trading perspective, right? And then there's situations from a fundamental perspective where you can have more gold bears, like in the example of 2022 and the dollar domination phase, when the Feds were aggressively front-loading rate hikes in the most aggressive fashion we've seen in history, a very unique event and a unique time period. We saw that that's obviously more of a bearish fundamental factor on gold, and gold go from the 2000s all the way into the 1600s. Now, from an intraday perspective, we've been in more of a gold bullish bias. Obviously, as we've been holding more macro bullish structure and due to the events that we've had stacking up on an intraday perspective, such as declining inflation figures leading to an outflow out of the dollar and more demand into asset classes such as the stock market and, of course, gold. But we still have to be objective and zoom out and understand key price points of interest that hold fundamental significance. Even though we've been having this rally that we've been primarily taking advantage of from the 1930s to the upside, which of course during this period of time where we've going from the 1930s into the 1980s, you didn't want to sell as you're pushing up from a day trading or scalping perspective. But as we've been making our way to the upside there, we're approaching a very important price point as we dig into the 2000s. Why is this important? Well, it's taken major fundamental catalysts to reach the 2000s and trade above. And anytime we have traded above, it's been relatively short-lived, no matter what the fundamental catalyst was. And what we can potentially see take place here is more of repetition, where if we don't have fundamental catalysts coming into play that hold equal or more weighting than these previous ones, new fear, uncertainty, and doubt to price in, then we can easily be seeing something like this take place in this repetition if we still hold below the 2000s and don't have any of that new fear, uncertainty, or doubt, right? Even when we had COVID lockdown, massive global fear, gold mines and production suspended during this period of time of lockdowns, which is less supply of gold where you still have higher demand. You can see we had monstrous rallies from that March 2022 crisis point after this correction into the 2000s. We broke above the 2000s for a very short period of time, less than a week. And then as that information gets priced in, we don't really have any new fear to match or exceed this. You can see from that point, we enter quite an aggressive corrective phase here, still maintaining macro bullish above the 1700s when we really zoom out in a second here. But from a day trading perspective, scalping perspective, and overall just a retail trading perspective, we're not looking to invest and hold gold buys for the next 5 to 7 years. We're looking to stay adaptive to these inevitable market waves and potential larger corrective phases that take place. So you can see here, even as you had this unique historical event of this pandemic leading to governments enforcing lockdowns and people stuck to the confines of their home, economies being stagnant, right? Which brings massive global fear and exponentially increases demand in gold, as you also have the stock market crashing during this period of time as well. So you have that change in risk flows. Even though those lockdowns led to gold mines around the world and production facilities being suspended or shut down, which limits supply. And because of lockdowns, deliveries from, like, we're talking about global shipments of commodities, which includes gold, was limited too. So you're having this impact on supply, which lowers supply and increases demand at that period of time too. And you have rising inflation with massive Fed stimulus. All of these catalysts are huge, right? And it makes sense. You had gold go from 1450s from that crisis opportunity point here, March 2020, all the way up into the 2050s. $600 an ounce, 6,000 plus pips, right? But as important as these fundamental catalysts was, as monstrous as this move was, we still have to be very objective that we did not maintain movement above the 2050s, very short period of time there, and then clearly started to get more signs of rejection at the 1980s and 2000s here. Right? That's it, 2000s. And then you can see a monstrous corrective wave where, yes, price action can be sporadic here in terms of the intraday where you have these monstrous pullbacks, but overall during this period of time, sellers are clearly in control and you want to be more on the bearish side, taking advantage of the impulsive moves down, right? Then you can see we had another fundamental catalyst come into play, which was Russia invading Ukraine. Global recession fears coming to the scene with exponentially rising inflation. Same idea, right? Very large impulsive moves from the 1750s all the way into the 2050s. But again, very short-lived amount of time above the 2000s, start to retest and pull back to that liquidity zone, start to break below these bit of support levels as well here, which we have to look at around the 1900s here. And you can see, if you, as that information gets priced in, if you don't have any new events coming to the scene, you can see buyers liquidating positions in very large bearish corrective waves, which this was also induced by these events being priced in. And then here, Fed starting their most aggressive rate hike cycle. What we coined in Capital Hungry as the dollar domination phase, right? Here, we had Fed pivot hopes when inflation first started to give signs of decline towards end of 2022 there. SVB, Credit Suisse, etc. Right? So this also Fed pivot hopes, which inverse the sentiment of dollar strength and led to more demand back into risk assets and asset classes such as gold and other commodities. But also then the main reason for these impulsive moves really here was more fear, uncertainty, and doubt coming from banking sector failures, new events that were bringing a lot of uncertainty, fear, and doubt that the market had to price in and adjust to accordingly, right? SVB with the Silicon Valley Bank, and then of course Credit Suisse fall out there too. But same idea where it's been very short-lived. Above the 2000s, now starting to get that rejection into the 2000s here, where if we still have healthy consumer confidence reporting, healthier labor market reporting, and what's very important this week is the FOMC, we have to understand one of the reasons why gold was so bullish in some of prior FOMCs that were very volatile is because if the Feds were bringing a lot of hawkish pressure or new events, and you saw a massive outflow out of the stock market, you would see this change in risk flows, stock market buyers hedging the risk being brought to equities by Fed's forward guidance, and you'd see them hedging that risk by pooling into gold, right? Now, we're not really going to see any major, shocking, surprising, volatile FOMCs. A lot of people don't understand that. FOMCs are not meant to be continuous surprise rate hikes or massive stimulus. Those were very unique periods through a crisis. The massive stimulus we saw when rates were dropped, and of course, money printer turned on, and money supply exponentially increased, and then all of their QE and asset purchase program and the whales riding that wave, that was a very unique time period. When they flipped the script as inflation was getting to high risk levels and they started their most aggressive rate hike cycle in history, that was a very unique time period of them front loading rate hikes, 75 basis point, 50 basis point, 75 basis point, right? The markets had to adjust to that accordingly in that short period of time. But now, as inflation is back to baseline levels, as the Feds have already front-loaded rate hikes, and they're not really looking, and the market focus, isn't really on the rate hikes themselves anymore, the Feds can take a way slower and steadier approach, which is what they prefer, to ensure market stability, not have monstrous increases in volatility as well. So if we see that the US data is still relatively optimistic. Feds are still just sticking to the guns of combating inflation, not really bringing anything new to the table at all. And as inflation's back to baseline, and it's going to take a lot more than Fed monetary policy now to keep inflation down there. So there's not really going to be any surprises from the Feds of like some crazy 50 basis point rate hike for no reason. That would still be a shock to the market. Then we can easily see that if we don't get any new fear, uncertainty, and doubt anytime soon, which we haven't seen any more banking sector failures, even though we have these military geopolitical tensions bubbling, we haven't seen anything come to the table that's actually holding market weight. If we don't get any of that, then just understanding these key price points and repetition, we could easily see gold do corrections back into the 1900s, potentially even lower before seeing buyers really come back into the market. Does that make sense to everybody? So even though we were playing buys up into here, we have to be very careful potentially switching our bias, as it's difficult when we're coming into these price points. It's very difficult to see any further buys if we're not trading back above the 2000s and don't have catalysts to support so. So just keep that in mind, that into the 2000s for gold is a very fundamentally significant price point. Now, this doesn't mean that my macro bullish view of gold is completely faded out. Gold is still very, very bullish on the higher time frame, but that doesn't mean we can't have monstrous corrections. That doesn't mean we can't see legs down back into like the 1800s before really seeing buyers come into the market. What's going to give me signals of seeing some larger corrections and not just continuous breakout buys is that if we don't get any new fear, uncertainty, or doubt, if we do not get any fundamental reason to see more appeal to gold's safe haven side, then seeing this type of repetition and a larger, higher time frame correction is what really is making the most sense there. Right? With the Feds keeping interest rates above 5% and higher for longer, there's not really the risk of inflation going back up to those higher risk levels above 7% or 8% or 9%. Inflation will be heavily fluctuating over the next periods of month and year as we're back to baseline levels and the base effect has passed. The base effect just pretty much explains that it's very easy to correct inflation that was primarily caused by a singular catalyst. In this example being the primary driver of inflation was monstrous stimulus by the central banks during the COVID crisis period. But they came on the flip side to combat inflation with equal or if not more aggressive tightening. That's enough to correct inflation from that 9% high risk back to baseline levels of 2 to 3%. But the difficulty is keeping inflation at 2%, which is going to require more than just Fed's monetary policy. That's going to require weakening in the labor market. That's going to require weakening in GDP projections and overall growth and economic activity. Right? So until we see that sign of deeper recession scares or further weakening in the economy, gold can easily see some corrective legs down before buyers really come back into the market again. Otherwise, even though we've been playing some of the buys up into this area, it's very difficult for me to see any more buys unless we're trading above 2000s. right? It's not just some random intraday high as well. We're talking about a fundamentally significant price point. Does that make sense to everybody? And the same time, we're starting to get some exhaustion here and buyers potentially liquidating positions and sellers starting to take control. We're starting to see dollar give us some more signs of rebounding. Where there is expectations, we can see some more optimistic US data reporting this week. So if dollar starts to trade back above and really hold above 101 and 101.4, and we don't have any reason to be revisiting these lows, we can easily see dollar starting to snap back above that very important weekly level. And this just being a much more aggressive, deeper liquidity grab that's been canceled out by a collection of optimistic reports. We've had optimistic jobless claims. We've had optimistic consumer sentiment reporting. PMI data was mixed, but there was a rebound in manufacturing. There's expectations that durable goods and consumer confidence is still going to be solid, right? Obviously, the focus is going to be on FOMC, but I don't really think FOMC is going to have too much market impact at all. I think unless they change something or bring something new to the table, it's going to be another copy and paste statement. It's going to be the same. It's going to be the same answers from Jay Powell. It's going to be the same slow and steady approach they have the freedom to take now, and that we've discussed in prior educational webinars. And I highly advise you watch and review the last FOMC webinars, the series of the prep, the live webinar, and the recap after. It's probably going to be pretty similar. But a lot of the dollar downside looks like it's been priced in there. But the key area is still around 101.4 to 101. To really see dollar buyers back in control, we need to be holding above here, which tomorrow can potentially come if consumer confidence is better than forecast. Retail sales has still been solid. We've seen obviously CPI declining back to baseline. Labor market still tight and healthy as well. So preliminary consumer sentiment reporting was very strong. So it's all pointing towards signs of consumer confidence being good. But it's already expected consumer confidence is going to be good. So it needs to be better than the expectations to hold significant market impact. But does everything I'm saying make sense to you guys so far? Right? So yes, we are playing the buys up to here on gold, but 2000s we can't just start to be subjective and start to hope and dream we're going to break higher. We have to remain objective and still get the most information from fundamental catalysts alongside price. Right? So just understanding that. Now with GJ, we do have Bank of Japan rate decision this week. A quick little central bank review. We have Federal Reserve this week, ECB, and Bank of Japan. Federal Reserve is ahead of the curve in terms of combating inflation and their goals. They front-loaded rate hikes a lot more aggressively than the other central banks, and they were moving from 0% rates up compared to the Euro Central Bank, which was going from negative interest rates and was a bit behind the curve on the rate hike cycle, right? Feds have already brought inflation back to baseline and are already holding the interest rate above the CPI level, which is a good sign of keeping it down towards baseline as well. Because the Feds have already front-loaded rate hikes, because they've already seen CPI come back down to lower levels, because the US labor market is still tight, this gives the Federal Reserve the freedom to take FOMCs way slower and way steadier compared to the stimulus crisis period or the dollar domination front-loading period. This is what the Feds prefer. They don't want to really bring increased volatility or market moves. They want to have a short and steady speech and go continue their day doing whatever the fuck they do, being rich, right? So a prime example of this is the last few FOMCs. We were literally sitting there with the previous statement on the screen and the new one, and 3 words were changed. You know what I mean? And we're just seeing lower time frame whipsaw moves, orders being collected both on the buy and sell side, indecision, and a lot of retail traders getting screwed, right? So there's very similar expectations for this FOMC. There's expected 99% probability to do a 97% probability. I think ECB's 99. Feds have a 97.8% probability to hike by 25 basis points. The least probable action is no change at all, which would be taken as a more dovish sentiment, right? But this is already very well expected. More than likely, they're just going to do this expected rate hike and then have a copy and paste FOMC statement, which is just going to lead to lower time frame, buyers and sellers getting swept on equities, gold, and dollar, and then really not having an impact on overall sentiment or structure. We really need to see a surprise larger than expected rate hike or the least probable action to see an increase in volume and volatility, or major changes in the statement versus the prior statement, right? Now with the ECB is expected to do the priced in 25 basis point rate hike, right? But they should be leaning more towards the hawkish side still in their statement and speech, because their implied rate is still only around 3.5 to 4. It's still well below their inflation levels, as Euro CPI is still at 5 to 6%. So they're behind the curve on their rate hike cycle. They're moving from negative interest rates to positive, so they have a larger gap to fill there as they're front-loading rate hikes. And CPI is not seeing as much of a significant decline compared to North America and compared to the US specifically. Especially now, there's going to still be impacts in the Eurozone as energy costs rise, because they're still dealing with a potential massive heat wave and everything associated with that and the impact of the energy sector. So European inflation is still elevated. They're behind the curve on rate hikes. They still have a lot more room to hike rates. They just can't be so aggressive with it. They can't, like, one of the least probable actions is seeing a 50 basis point rate hike. I was discussing this with Sebastian. European central bank should have been doing 50 basis point rate hikes to get ahead of the curve on inflation. But they know they can't because their financial sector is way too weak to handle that front loading of rate hikes compared to the US financial sector, right? This is why we saw such a larger bank fallout with the European side with Credit Suisse compared to in the US, where you had like SVB, which is just some like shitty little tech bank, not like a major systemic bank. So they should be more leaning towards the hawkish side, still bringing some demand into euro short-term and intraday. Bank of Japan is probably going to have a buy the rumor, sell the news play, because we've already got confirms from UADA the previous week that they're sticking to the status quo. They're already priced in and expected to do no rate change and just stick to a dovish sentiment, right? So we could see short-term strength in the yen, actually, an inverse move, like a priced in style move, and then that get faded out later and sellers come back into the market from a macro perspective. So with that being said, we could see GJ easily retesting into these demand zones again before turning bullish, and UJ having that same type of liquidity grab down before turning bullish. Other than that, what I want to look and forecast here is understanding gold rejecting that important price point and still holding below 2000s. And of course, dollar potentially coming back above that important weekly level, especially if data reporting tomorrow is still relatively optimistic. Now, overnight, We have some chain store sales data for Japan, which is expected to still be relatively solid. It's not going to hold that much market weight at all. Main focus is just the Bank of Japan rate decision this week. We have some business climate reporting for Germany at 4 a.m. Eastern. Still expected to be shitty, weak data. Can keep euro softer if it's worse than the expectations here. We have some US housing data here at 9 a.m. Eastern with house prices. Expected to show a bit of a decline, which is understandable in a higher interest rate environment, and especially how overinflated real estate prices have been. So that shouldn't really hold that much weight, and especially if it's just within these expectations. At 10 a.m. Eastern, we have consumer confidence. Now, for the reasons stated, healthy labor market still, CPI back to baseline and lower cost of your basket of goods for the consumer, right? Credit card activity still very high. Consumer confidence is already expected to be showing an increase. To bring dollar strength or to see an outflow out of gold, we have to see consumer confidence come out higher than this pole. Otherwise, if it's lower, it can still lead to gold bouncing a bit bullish up until FOMC and dollar having a pullback from 101 area there. Now, this is going to line up very well with some of these key price points because in the example of gold here, gold now, if it holds below this 1960s area and how we can extend this structure now with these intraday lows printed, even if we get pullbacks into this area, we're still holding bearish to be digging into the 1945s and 1940s, and especially if we break below these lows. We can only really see bad data holding significant weight if gold is trading back above the 1965s in this important liquidity zone we were looking at, which we're actually seeing sellers in control below here now. Right? Now, this is going to go well with the dollar now because I can only see any chance of dollar weakness if we're trading back below 101. Bad data would not just need to lead us to a downside move, we'd also need to be trading below here and seeing this type of formation to confirm sellers back in control. Otherwise, if we hold above 101, and especially if we correct this downside move and start breaking these intraday highs, just shows that dollar buyers are still in control here, especially if we get more optimistic consumer confidence reporting. So I do want to start to look for some gold rejections in bears, especially below the 2000s. Even FOMC might give us a sweep of the 1970s and 1980s again before selling. But other than that, it's difficult for me to see any more higher time frame gold buys if we're holding below 2000s. And with the data rebounding we've had, mixed PMI figures today, labor market still healthy, and if consumer confidence is good tomorrow, we can still see dollar holding more bullish if we don't break below 101, and especially if we break above 101.4 area here. Yen is still bearish, which we want to take advantage of, and seeing some more dollar strength in yen bears would give us some pretty clean one-sided volatility for UJ buys as well. UJ saw a very nice correction that took place from that price point where Japan did currency intervention previously. Really just dug into this liquidity zone of interest here and starting to see buyers come back into the market as we're still overall in bullish structure, pull back from these higher highs, still maintaining a bullish sequence of events, even if we get some minor pullbacks into the 140s. Okay. So with that being said, I'll drag this. And this is just as a visual representation that sellers are still in control on the intraday as long as we're holding below 1965 and if we don't have any new fear, uncertainty, or doubt. And also to include, we might not see any significant buyer bounces if we're trending lower, until we go back into the 1940s, which is this liquidity zone of interest here. And also, we're continuing to hold below here is important. So if we continue to hold below 60s, have optimistic data, dollar strength, we might not see an aggressive pullback or bounce, or I would even anticipate some buys until back into like the 1940s. So this gives us very clean-cut information that I'd only see safe buys with bad data, new fear, uncertainty, or doubt, and breaks above 1965. Otherwise, new daily candle pullbacks into this liquidity zone and range low that we broke, sells, break below 1953 sells, break below 1945, and then would potentially anticipate some buys into the 1940s, which I was showing you there on the intraday timeframes. GBPJPY, I'm still technically and fundamentally bullish. I'm still primarily just playing the macro rate differential of a dovish Bank of Japan versus a hawkish Bank of England. We're still holding above this demand zone. This is still a secondary phase of market structure, which is a pullback from these highs. Very nice bullish structure as well. Looks like on the higher time frame, we're pretty much just going to be, especially as Brexit has seen some resolutions now, we're pretty much going to be going back to pre-Brexit prices here, chugging away, give or take some higher time frame pullbacks into the 185s and 190s. Very similar historical repetition to the post 2008 crisis period, and same thing with post pandemic period here. If we break below 180.8, I would see a short-term squeeze to the downside to 179.8, 180 before buyers come back into the market. Otherwise, if we just trade above 181.5 and especially above these candle bodies at 182.2, we'll just see some continuation buys. If we come below 180.8 and you want to scalp the sell play down or take advantage of it short term, you can do that until we can see some reactions at that better buyer demand zone there. But we don't have any signs of Bank of Japan shifting policy. UK still has inflation elevated and needs to stick to their inflation fight from the Bank of England perspective and keep rates up higher for longer. We don't have any new fear, uncertainty, or doubt to change intraday risk flows. So now with Euro USD, we've had some bad Euro PMI figures, but we just have to be cautious about ECB. We could easily see some larger corrections up until ECB with some dollar strength going into like 1.09 before starting to see buyers come back into the market. You can see we had an accumulation phase here where from this accumulation phase started to get that dollar weakness with declining US CPI leading to these higher highs. And the corrective waves on Euro USD and dollar pairs are quite large as well. So if we're still maintaining some of that dollar strength, we had weaker Euro PMI figures. We still got some time up until ECB's rate decision and can easily see price setups into there. We could be going down into 1.1, 1.09 before starting to see any chance of buyers coming into the market if we don't shift out of this pullback structure in the near term. Shifting out of pullback structure in the near term would be coming back above 1.114. Otherwise, I personally still see some Euro USD sells below 1.11, below these candle body lows, and below 1.04. And this deeper corrective wave to potentially be retesting those buy zones I'm showing you on the higher time frame there. I would only adapt to buys from current price points if these sell areas are completely invalidated, very poor US economic data, dollar giving back some gains, and Euro USD breaking above 1.114. Similar to Euro, UK also had very bad PMI reporting, and it looks like we're entering one of these aggressive corrective waves, which can be hundreds of pips in size and last a period of days or weeks. Now we're at a key area of interest, which is roughly these previous highs, where if we maintain below there and still have dollar strength, and Bank of England rate decision is until first week of August, we can easily see some downside moves into these demand zones before starting to see buyers really come back into the market, as long as we're not breaking out of this corrective phase of market structure right now. Breaking out of the corrective phase of market structure here would be GBPUSD trading back above 1.29 and maintaining above these previous intraday highs. Anything below there is still just looking like pullback waves to retest into these better demand zones. Bringing that information together to the table right now, I would still be looking for these pullback corrective wave sell plays. Can only see buys really back above 296, 293 area as an adaptation point. USDCAD is just in a heavy consolidation, which it's easier just to play the range breaks. I can see short-lived downside to retest this better buyer demand zone we've been looking at on the weekly level, or safer clean intraday buys above range highs and key level 323. USDJPY, we have the macro rate differential of a more hawkish Federal Reserve and more macro demand in the US dollar versus a dovish Bank of Japan, leading to a weaker Japanese yen. We still have very bullish market structure on the intraday and higher time frame price points we can revisit back into 145. We're showing a lot more life out of this corrective structure with buyers in control. We just have to keep in mind, Bank of Japan priced in rate decision can lead to aggressive liquidity grabs before buyers come back into the market here, which you can see is very common with UJ or yen pair movement overall. I would see short-term downside plays and those liquidity grabs taking place if we break below 140.83 and then buyers back into the scene, retesting the accumulation and key level at 139. Otherwise, just safe continuation buys above this intraday zone and the last candle body highs in 142.4. US 30 giving us continued squeezes. We don't really have any reason to sell except at FOMC. You may just see a priced in move as a lot of the soft landing expectations and previous Fed signals got adjusted accordingly. Right now, we still have the volatility index relatively flat, but just holding above an intraday support at 13.2. I can only see some type of US 30 pullback and downside below 33, 350, which I'd be looking for reactions at 35K and 34,600. Otherwise, safer continuation buys above the next liquidity zone and key level at 35,500s. All right, everybody. So a little bit of a fundamental review on gold and higher time frame price points, a little bit of a breakdown of rate decisions and expectations for this week and understanding why, breakdown of data expectations when we have on the schedule, and then your intraday analysis and trade ideas across the board.